Hello everyone, and welcome to EHLRecap session for topics in financial analysis. My name is Michelle, and I'm the BOSC2 coordinator. Just for a small rundown of our committee, we post free content during midterms and finals for students by students. We give short presentations and answer any of your questions at the end of the sessions. Our material is posted exclusively on our website, and we have worked with professors and students who have taken this class before to put up this material and made sure it is up to proper standards. Also, we are now affiliated with EHL and are a brand new committee this semester, so please don't keep us accountable for your results. You can always find the session link on our Instagram bio at EHLRecap, and on our Instagram page we post reminders on future recap sessions and anything else you need to know. Now in the group chat, I will send the link to our website, Instagram, and YouTube channel, and also the password for the material on our website. Thank you for joining the session, and without further ado, I will pass the time to Maj, who is our tutor for today.
So hello everyone, I wish you a wonderful evening and thank you for joining this EHLRecap and SHS session for TIFA. So first, let's look at some basic information for today's session. So any questions are more than welcomed. You can always raise your hand or just write in chat. Session will be approximately 1.5 hours. Recording will be later available on YouTube, so you can rewatch it at any time. If you cannot stay for the entire lesson today, you can watch it then later on YouTube. PowerPoint, I think, is already available on the EHLRecap website. And the session is generally made out of two parts. So first, we'll go through the course, and then you can ask any questions from the quizzes that are on LMS, any other material, or just general course questions. So here's also the agenda. So we'll start by repeating just some financial statements. This is just short revision. Then we'll just deep dive into financial analysis framework and just repeat all the ratios. Maybe we'll just take some time to repeat operating cycle, because that's what some students said, that it wasn't really the teacher didn't really spend a lot of time on an operating cycle, let's put it that way. And then also free cash flow, because that's what Ms. Erbelding said, that usually students have most problems on the exam. And then also we'll do some solvency analysis and market invest ratios. And after that, there will be time for any questions you will have. So let's start then. So first, just a general recap, as I said. So this is the picture that this teacher said it's the most important for the recap of the basically financial accounting. That's what you need to understand and what you need to know to successfully pass this exam. So that's how we get from the beginning balance, how do we get to the ending balance. So always just look at this graph and make sure that you understand every part of it. So it always starts with initial balance. You will have your current plus non-current assets. There will be one part, so the total assets, and then the liabilities and equity will be another part. So we are speaking about, of course, the financial equation, basic equation. So funds that we have, that are assets, and the providers of the funds, that's the equity. So these are the fund that we have, and of course the liabilities, that's are the fund that the debtors lend us the money, so they have also a part on our balance sheet. So the most important financial statement for TIFA is a statement of cash flows. you have to know how to calculate operating cash flow. That is the topic of financial accounting. Investing and financing activities are usually not that problematic. But anyway, if you have any question, feel free to ask. Then there is a statement of stockholders' equity that we didn't really pay too much attention in TIFA and income statement. That, of course, you also need to forecast. And then we have the ending balance. But as I said, it's more just a short revision of last year. Okay, so we'll now just take a look at the three financial statements that are important for TIFA. As I said, statement of stockholders' equity is not really important for this course, so we'll leave this one. So the balance sheet, as we say, everything starts with balance sheet. We always need to make sure that our assets are covered by our financing. So what we have, this needs to be provided by someone. So liabilities, as I said, these are the assets provided by the debtors, so by the banks, and the equity is the money provided by investors and also the money provided by the owners. So that is the owner's share of the company. So as we said, assets, they use funds. So the funds are provided by liabilities plus equity, and this is the base of the financial equation. So sometimes you need to know the difference between, for instance, liquid assets and current assets and fixed assets. So usually the assets on the balance sheet, they are sorted according to liquidity. So always the cash is first, because we can always just use cash first. And for instance, then after cash, we have accounts receivable, because accounts receivable will be provided. So we'll have money later than cash. So cash is the most liquid current asset. And fixed and non-current assets are just a term used for the assets that we cannot transform to cash within a year. Current liabilities, these are usually accounts payable, salaries payable, dividends payable as well. So what's the difference already here? Maybe we can mention what's the difference between accounts payable and notes payable. If someone forgot, so accounts payable is reserved for the inventory. So that's the account that we will not pay interest for. Usually your provider, your distributor, or the company will give you 30 days to pay for your inventory. So that's where you will put your liability, and that's just for your inventory. Any other debts that are contracted with a bank or any other financial institution or any other private company that will lend you money, that will go to your notes payable, because that's what you will also pay interest on. That's at least in this course. Long-term liabilities, sometimes, usually this year we have some mortgages payable, so don't be distracted if you see on the exam, mortgage payable is just another term for long-term liability. So this is just usually you have repayments of the mortgage and you also pay the interest. But if you see that on the exam, that will probably be a separate account, so don't be distracted. Then you have the equity. Always be careful when you have to forecast something. Never forget to add the net income to your retained earnings, because that's what, according to a professor, happens a lot. And always be careful about accounting value versus market value. So you never use market value in accounting. You always have to use historic cost, but that's more of a revision, as I said. Also, the income statement, so maybe just shortly why we are doing this revision, because probably you all know that, but usually in the exams, there is the exercise at the end where you have to do a forecast, and then it's very, very useful to know this. Just a quick warning. So net income is not net cash flow, because you know how to get from the net income, you know how to get net cash flow. So you also have some non-cash expenses, and usually if you have a positive net income, your positive change in net cash flow will be even higher. So you have to be careful about that. And when you calculate the cash flow, you always have to also add the previous balance of cash. So be very careful on that as well. If you are asked in the exam to calculate the ending balance of the cash for this year, don't just calculate the change in cash and write this number as an answer. You always have to sum the change in cash with the beginning balance of cash. So we have to distinguish between wealth and cash, because sometimes we have long-term assets that are not as liquid as cash. Just if we just summarize, let's summarize the profitability of a firm. That's usually because the income statement is mostly used by the companies to calculate the tax. And more important for a lifespan of a company is, of course, the cash flow statement, because as long as you have a positive cash, you won't go bankrupt, even if you produce, even if you have negative net income. So if you have net loss each year, that doesn't matter as long as you have a positive cash flow. So functional expenses, we just mentioned. So these are the expenses that are not incurred by the departments, these are the expenses incurred by the departments that do not generate revenue directly. So your HR department, they don't generate revenue directly, marketing as well, maintenance. But of course, we know that these are all very important expenses. Just we say they are functional because they are important for the company, but they do not bring money directly. So this is the most important statement, as we said, statement of cash flow. So only transactions affecting cash are recorded. That's what we know from last semester as well. So it avoids judgments which may affect recognition of expenses or income. So you have to know the difference when cash is received or when revenue is input in the account. So that's usually a different term. We don't get the cash in the same moment that we incur the revenue. So that you have to know the difference, that it's a different when you earn revenue and when you receive cash, but that's as well financial accounting. The most important cash is CFO, so cash from operations. That's our daily bread, as we say, and this one must always be positive. And also one of the most important ratios that we'll see later, the ratio that's quality of income. It compares actually the net income to the CFO, because of course you can get a positive net income also by selling lots of long-term assets with big difference. So if you sell usual, because the difference between acquisition or historic cost and the market value sometimes can be really high. So if you sell a piece of land that the company bought 50 years ago, now you will have a big gain, and your company will seem to be very profitable. But actually, we have to always look at our cash from operations. That's just a small reminder that what she said once and what may be important for forecasting in the exam. So before we open actually the company, we cannot have expenses because we cannot have revenues. That's a rule. So if we have some pre-opening expenses, they always go to balance sheet and the account is then depreciated. Interests are only paid for the sum of money owed at the beginning of the period. That's also very important. So sometimes if you have different periods, always calculate interest just on the beginning balance of a long-term debt or long-term mortgage. Okay, so we finished our revision of financial accounting. So now we can start with our revision of financial analysis. So maybe shall we start with how the company creates value? So we have two parts. So it's very important for potential or present owners. So owners are the investors, shareholders, stockholders. So they own the company. They own the part named equity, as you know. So it's very important for them to know how profitable is the company. So that's why we have some ratios to assess this. We also can assess solvency and liquidity of the company. That is not so important for our owners. Solvency, that's very important for the banks. If the company wants to contract some extra loan, the bank will calculate the solvency ratio to see if the company is able to pay back the loan plus the interest. That's also so that what we have to distinguish. And then we also have some market and investor ratios that are also important more for the owners, but we'll take that a look of this at the end. So our goal is to provide an overall assessment of the current situation. That's what we want to find out when we calculate these ratios. We want to see if the company is worth investing in. And we also do some trend analysis. So usually we do horizontal and vertical analysis, and we see to compare to benchmark how successful was the company. Usually our financial framework consists of 5 steps. So the first one is always a preliminary step. We do economic analysis, we can do PESTEL, we take a look at the strategy, market segments, product competition, and risks. But this is not really a topic of what the exam is probably going to look like. So what's important for us are the 4 steps. The first one, income statement analysis with revenues, expenses, and costs, of course, and then liquidity ratio, solvency ratio, and market investor ratios, as I said. So if we repeat in the first ratios, they will be important for owners, and then liquidity and solvency ratios are not important for investors and owners, but for lenders. So for the banks that will see if they can lend more money to the company. So first, the preliminary step that we will do in this course are actually 2. So we won't do PESTEL, for instance, but we will do vertical and horizontal analysis. So I think you should all know that, how to do it. So vertical analysis, it's everything compared to the total revenue. So all numbers are calculated in the percentage of total revenue, and we usually just in the Excel, when you calculate it, you will lock the total revenue cell and you will divide every cell by the total revenue. So, and with this, you can only compare the changes in proportion. So be careful. You may have, if you have different amount of total revenue, it doesn't make sense to really compare compare year by year analysis, but just the proportion of the same year. Its aim is to compare with the benchmark. So usually you say, so let's say we can have maximum, we need to have room revenue of 70%. So you will divide the room revenue to total revenue, and then you will see if you met the benchmark or not. Horizontal analysis is the analysis that will compare your results to the previous period. So you remember, it's not just in this course, but in every course, if you want to calculate the change from the previous year, you always calculate it with this year minus the previous year divided by the previous year, and that will give you the percentage of the change between the current period and the past period. So first we have, so we'll start now with our income statement analysis with our ratios. So first one is a profit margin. That's probably the one that we all know. It's very easy. It's just net income divided by net sales revenue. And just remember, if you have to do some forecasting or anything, net sales revenue, it's revenue minus sales returns and sales allowances and discounts. So if you have a case, for instance, on the exam that the company granted some discount to one of the clients, you will have to deduct these discounts when you calculate the profit margin. Then you will have a quality of income, the one that I've already mentioned it before. So it's cash flow from operating activities, CFO. You will divide it by the net income of the company, and the higher it is, the better the performance. But it should be usually around or above 1. So CFO, it's nothing else than the net income plus depreciation and other non-cash expenses minus gains plus losses, and then the change in working capital. You will compare the cash flow earned, so you will compare your daily bread to your actual net income. The company actually cannot have too much cash in operations. That's a very important part of the theory. You can have too much cash, but you cannot have too much cash in operations. So that's what may be important for the theoretical part. Fixed asset turnover, it's the one ratio that can be tricky. I'll tell why. So it's net sales revenue once again, but it's divided by average net fixed assets. So it actually shows how much money does the company produce every year for the proportion of the assets that they own. So how many dollars they produce for each dollar owned in the assets, in the fixed assets, of course. So fixed assets, as you know, these are usually the buildings, the machines. These are all the assets that won't be transferred to cash within 1 year. So these are usually the tools, or as we can say, prerequisites for the company to produce money. But you have to be very careful with this one, because if the company is very asset heavy, so for instance hospitality, because you need to have a building and you need to have some equipment, so hospitality companies are usually very cash heavy. If this ratio is too high, that can mean that the assets are very, very, very highly depreciated, and that means that the net value of the fixed assets is very low, but that doesn't mean that the company produces so many euros for dollars for each dollar in asset. That just means that the assets have a very, very low value because they are very old. So you have to be very careful when you take a look at this ratio. You always have to ask yourself, is this company an asset heavy company or an asset light company? So for computer or IT companies in general, it will be totally normal to have this ratio extremely high. But for instance, for real estate, for hospitality, if this ratio is too nice, there's something wrong with the company. So generally, this ratio shows the ability of the firm to use its fixed assets to generate revenue. So fixed assets are usually very expensive part of what you have to purchase. So that's why it's important to really to know how to generate money from these assets. It indicates also productivity, because the fixed assets are usually the most important assets for your production, for your daily bread. So be careful to always take average net fixed assets. They are net of depreciation, as I said, so that's why it can be misleading. And the average is used to avoid any last-minute changes by the company to actually show different ratio than it's in reality. So that's why we always use the average. So as I said, it's for every dollar that we invest into assets, how many dollars do I generate? And as I said, also, you have to distinguish between heavy asset companies and heavy light companies. But in generally, for hospitality, because the companies that we'll have on the exam will usually be the hospitality companies. So as you can see you can see in the previous exams, usually it's about restaurants or catering companies, or about hotels sometimes as well, but rarely. So for restaurants and other hospitality companies, this ratio should be around 40 or 50 cents. So around 0.40 to 0.50. But as I said, for computer or IT company, the ratio of 0.5 will be crap ratio. They need to have a ratio or at least 2 or 3, because they are asset light companies. If you see that the hotel has a ratio of 2, that's very suspicious. Check the net assets account, check if they are investing. Also, when you will have to decide for which company to invest in, this is usually the trick that she uses. So if you decide, you can be misled by this. So please be very careful with this ratio. If you decide to use this ratio to rate to which company you want to invest in, just check if this ratio is too high. That means that the company's assets are highly depreciated, and you have to check if the company can afford to invest to refurbish these assets to get them to the standard again. Yeah, so high ratio can also mean, yeah, exactly. So that's it for this one. Return on equity. So this ratio is important, not really for the company to show its productivity or anything, but at the end of the day, the company has to serve its owners. So this ratio will show us how much money does the company actually produce for the owners. Later in this course, we'll learn how to calculate cost of equity. But for now, the cost of equity will be given in percentage. So I think on one of the mock exams provided, previous exams provided on the LMS, it says the cost of equity is 10%. So when you see the cost of equity, just write it down or highlight it, because you will need it when you calculate a return on equity. Because this one can be, so my suggestion is this one can be really useful to decide which company to invest in, because when you decide to invest in a company, it will be important for you to have a return. So if you start with a small company and it gets larger and larger every year, and you end up with owning a very, very large company, that will not be as important for you because you have generated a lot of money in the past years. But if you are an investor, this ratio is very important for you. So if you see that the ratio is higher than the cost of equity, that's a really good sign, and that's a very good argument to use for the analysis that you will have to write on the exam. So it's how much is earned for every dollar invested by owners. So it compares net income to average shareholders' equity. Again, you have to use average shareholders' equity, because we use average to avoid any fluctuations that could be done by managers last second to mislead the people reading the ratios, and owners, of course, because this ratio, as I said, is very important for the owners. But there is also a trick in this one. Unfortunately, there's always a trick, and this trick is called the treasury shares. You have to know that the treasury shares are deducted from the total equity. So if you have to calculate this one, in the exam, be sure that you deducted the treasury shares, because it's very good if the company has a lot of treasury shares, because this will increase the ratio, right? If you have a lower denominator, the total then ratio will increase. So the more then you have treasury shares, the better it is. But you have to be careful that you take the treasury shares into consideration. In finance, return is not entire net income. What the last section means is that no matter if you pay dividends or not, this is the return that your company gets. It's the net income. Why? Some companies don't. I think I'm pretty sure Amazon, they don't pay dividends. Tesla as well. That's very, very modern. And in this modern era, these companies, they just don't pay dividends, and the investors are okay with that, because the retained earnings will be used to expand the production. That's why, and when the production expands, the company will produce more money, and that will boost the share price. So if you do not get a return in terms of dividend, you will get it in terms of the share price, because you will be able to sell your share for much higher money that you bought it. So if the company, that's also a thing. If you have more treasury shares than you have the other part of equity, that's also tricky. You can be a very large company that's doing pretty well, and you bought a lot of treasury shares. So at the end of the day, you have more treasury shares than you have retained earnings, that you have common stock, that you have any other account in the equity. So if your treasury stock account is larger than all the other equity accounts combined, of course, this ratio will be negative, but this doesn't mean anything. So that's actually very, very good, because that means that your company owns more than half of the company is actually owned by the company. So key cost of equity will also be given on the exam, and that's what you need to know about this ratio, I think. So return on assets or return on investment, it's also called Dupont chart. So for this one, you will have to calculate the profit margin, but be careful, this profit margin is not the same profit margin that we saw at the beginning of this recap. This one, it will always be written profit margin for ROA. So this will mean that this profit margin is meant to be for to calculate return on asset or return on investment, as whatever you need to calculate. So you want to exclude what? So what you want to exclude with this profit margin? So you take EBIT and you multiply it with 1 minus tax. So why? Because EBIT is earning before interest and tax. So you want to exclude interest, because interest are usually good, because if you have to pay a lot of interest, that means that you have a lot of a long-term loan, and that means that the company is expanding, because you can't expand without money, and usually that also you have to be careful, but usually it means that the company is investing, and that's absolutely fine. But just be careful, because there are some companies, like I think we saw the example of Hertz, that they have 18 times more liabilities than equity, and that's the extreme. That's absolutely not working anymore. So you have to also calculate the asset turnover. So you will you will have to calculate net sales and divide it by the average assets. And when you calculate this, you will just multiply this to, so return on assets equals profit margin for ROA and multiplied by the assets turnover. By calculating, so that's also important why you take the EBIT and not the net income, as that the result does not depend on your choice of financing. So we mentioned already today, I think 3 times, that we have 2 ways of financing. First one as the equity. So this is when the company is owned by investors and by its owners, and the liability. And this is when you get a loan from the bank. So the industry norm here is the higher the better, the sky is the limit. You cannot compare companies in different countries and different industries. So be very careful. Sometimes also the tax rate will not be given. So you will have to calculate the tax rate, but I think that shouldn't be too problematic. You just divide the net income by the EBIT to see how much money was deducted. So by EBT, not EBIT, because it's just in earning before tax with EBT, and then you have the net income, and the difference is what was deducted for tax. So here we have the next one, financial leverage. That one will tell you if the company can, the money that's borrowed, if the company can use it to produce more than what you have to pay for it. So financial leverage will tell you if the company is using the funds provided by debtors well, because that's what the easy explanation of this one is. If you borrow money with 5% interest rate, and then you lend it further with 2% interest rate, that doesn't make any sense. You are losing the money. So this one will tell you if you can actually take advantage of the money provided by debtors and invest it to be more profitable than what you have to pay. So it shows the relationship between return on asset and return on equity. So this one is just ROE minus ROA. So it's minus what you produced to return to your return on investment. So what you are producing for your owners, minus how productive are you on your assets. So whatever is left is the financial leverage. Leverage is usually that's a financial word for debt. If the leverage is negative, the return for shareholders is diminished by debt. So what it means, so as I said, this was my example before, if this is negative, then it doesn't make sense to contract the loan because you cannot use this money probably to produce more than what you have to pay to the banks. But when it's when return on equity is negative but return on asset is positive, that means that the company is heavily affected by the interest, and that means that the company is not necessarily doing bad. That's what you also have to be careful when deciding for which company to invest in, because if that's the case, that doesn't mean that the company is not profitable. It just means that they had to contract the loan and they are now heavily impacted by the interest. But the interest, as I said, are not necessarily bad thing. Simple example, as I said, and the industry norm, it should always be positive. If it's negative, check what's wrong, because if it's negative, there can be many different factors that can be wrong. So it can be negative because ROE is negative, and that would mean that the interest expense is just affecting the company like heavily. If ROA is then higher than ROE, this ratio is negative as well, but that means that the company is not using the money properly. So ROCE, return on capital employed. What's the capital employed? Again, capital employed that is calculated by total assets minus short-term liabilities. So capital employed is long-term liabilities plus equity. Why? Because you can choose two ways of financing your company: debt and equity, as I said. So that's the capital employed. Capital employed is the money provided by the sources of financing the company to be used for production. So here you also have to take the EBIT. Why? Because you don't want this ratio to be impacted by the interest amount that the company has to pay. It only considers invested capital, so financing that has cost attached to it. And if it shows if you generate enough to cover the cost of initial investment. Once again, there is no industry ratio for this one. You have to see and analyze it. What is it? But once again, it should not be negative. So that's what you have to know. So it should always be positive, but we cannot say because it's a really huge difference among the industries. Okay, now let's move on to liquidity ratios and the operating cycle. So the first ones are really easy, so we'll go through them quite quickly. Once again, if there are any questions, feel free to ask. So first one is the current ratio, and the current ratio just compares our current assets to our current liabilities. So using this ratio, your potential debtors, so banks, will see how, or even your potential debtors can also be for your distributor, for your the company that's providing you with your inventory. To see how fast you are able to cover your current liabilities, right? So this is important either for the bank if you need a short-term loan, or for your supplier. So as you can imagine, when you divide current assets by current liability, you will get a ratio. So if that ratio is 1, that's your base. So if it is 1, that means that the company has the same amount of current assets and current liabilities. That simplified, that means that you can pay all your current liabilities at any moment in time. That's usually when your supplier is very happy to give you inventory on credit, because he's quite confident that he's going to get his money. But on the other hand, in hospitality, we do not have a lot of current assets. Why? Because we do not have a lot of inventory. So this one is not that important for hospitality. That's also why industry norm is lower for hospitality than for production companies. It's also interesting to see this one for IT companies, because IT companies usually they don't have much current assets, they don't have much current liabilities. So this one you always have to look also. You have to take industry into consideration when deciding on how to use this one actually in practice. But as I said, when you have the exercise on the exam to decide which company to invest in, do not use liquidity ratios, because that's not how you decide on which company to invest in. You can actually use them to decide against a company. So you can say, no, the current ratio here is -2, so I'm not investing in this company. But if you decide to invest in a company, then don't use liquidity ratio to support your claims, because that doesn't make any sense, because they should be all well if the company is healthy, if the company is doing well. So this ratio should not be really important for the future potential of the company. So quick ratio. So we will have three more ratios, and we will always shorten the part that's on the upper part of the equation. So we had current assets before, and now we have just cash equivalents, and accounts receivable. So we always narrow the selection, and in the denominator we'll keep having current liabilities. So now we will compare, because before we had all current assets, and now we'll only have the most liquid ones, the most liquid three current assets. So we will go further on how much can we pay immediately, because for some current assets, it may take maybe 7, 8, 9 months to get actually the cash. But if you have cash and cash equivalents and also cash receivables, that should take mostly 30 days to get the cash. So for hospitality, it should be around 0.5. Very high ratio would suggest that we are carrying too much cash. So be careful. Also, it's not good to have too much cash. You cannot have too much cash in operations. But if you just have a lot of cash laying around on your balance sheet, that's not well used cash, because you can lend this cash to another company and get interest. You can invest in the new building that will give you return. But just having a lot of cash, so if this ratio is 10, there's something wrong with the company. So this is the ability to immediately pay back the short-term debts. But the next one will be even more urgent. So it's just cash plus cash equivalent divided by the current liabilities. But honestly, usually these are not the ratios that you will have problems with. Should be pretty clear. This one for hospitality, it should be around 0.15. Because sometimes you can have a lot of current liabilities in hospitality because you have prepaid rooms. So all the prepaid rooms that you have for 1 year, for the next year, that will be your current liabilities, right? Unearned revenue. They will pay you for the rooms. So that's why also these ratios are a little bit lower for hospitality than for companies. But you have a problem if this is negative, because then your balance on the bank account is negative. And if your balance on a bank account is negative, that's very, very bad sign. No matter how you cut that cake, it's not going to be good if your bank balance is negative. Okay, so working capital. What's actually working capital? You will use working capital or let's say change in working capital to calculate the free cash flow. So it's margin of safety to pay current obligations. It's usually, it's just basically just current assets minus current liabilities, but it cannot be you really compared. Be careful, especially if the companies are from different countries, because they use different currencies. you will compare. So you will compare the current assets by current liabilities. So positive working capital will mean that you have more current assets than current liabilities, and of course, if it's negative, you have more current liabilities than current assets. So change in working capital is as important as working capital itself. I don't know if I hope you remember how we calculated working capital last year. At financial accounting, we took every account. So for assets, you remember, if you deduct this year minus last year's, you will get the change. But for assets, you will have to change the sign. So if it's the positive change, you will have to get minus, and if it's negative change, you will have to get plus. But for current liabilities, the sign will change. So if your accounts receivables, accounts payables, they increased by 10, you will just plus 10 when you calculate the change in your working capital. So for assets, you change the sign. For liabilities, you keep the sign. But this year, you also have a way in Excel. So it's just the sum of current liabilities minus sum of current assets minus the sum of current liabilities, and then you calculate the change in working capital. And that should be the fast way of doing it in the Excel. It should be slightly negative. Why? I mean, that's one of, I think, really few ratios that should be slightly negative, because that indicates that you have a lot of accounts payable. And accounts payable, this is the best account that you can have, because why? This is free money, right? You are not paying the interest on the accounts payable. Your supplier is giving you inventory that you sell maybe the next day, and you can keep the money for 30 days. So that's why it's preferably a bit slightly negative, because you have to take advantage of the free money. The operating cycle, that's a theoretical concept of this course, one of only few, and it's how fast you can generate money and how fast you can so if your cycle is very short, that means that you should be generating money multiple times in a month. But if you are, for instance, a farm of caviar, I think it's around 20 years one operating cycle. So that means that you should have more assets so you should have more operating cycles, because if you are going to wait for 20 years, you will bankrupt, right? So that's why it's important to calculate the operating cycles. That's a problem with small businesses. Sometimes they do not have an accountant, and they depend very much on accounts receivable, because they usually work for larger companies, and the larger companies, they usually say, yeah, no worries, we'll pay you within 30 days, and that they can go bankrupt, and then the smaller companies are screwed. But anyway, that's not that important as this is. This is important. You have to calculate 3 indicators. First one is average collection period, inventory holding period, and payable deferral period. Only use 365 if your company is open 365 days a year. Also, this accounts receivable, accounts payable here in this course is reserved for the inventory, as I said. Sometimes, be very careful, sometimes you'll be asked to calculate the operating cycle for food. So if you have to calculate food operating cycle, then you will have to use cost of sales, so COGS, only food COGS, not the entire COGS, only food revenue, not the entire revenue. So be careful, right? Because if you have to calculate the food operating cycle, then you just take the food accounts into consideration, not all accounts. Okay. So when you calculate these 3 ratios, you will get your operating cycle by this short equation. So collection period plus holding period minus deferral period, that will give your operating cycle. It's also, once again, it's preferred to have a slightly negative operating cycle, because that means that you are using your deferral period. Well, why? Because deferral period it's just the once again the free money, right? And also, if it's slightly negative, that means that you are getting cash before you have to start again. So that means that there is no need for injecting cash every few months. Okay, so yeah, and you have to also compare it to the competitors. So this one can be very important. Also, accounts receivable, inventory, accounts payables, and other expenses, budgeting and analysis. Why? You have to distinguish between budgeting and analysis. Usually on the exam, there is one short exercise for budgeting. So that means that you are calculating the future balance, the balance after first year of operation, the balance after second year of operations, for instance. You will usually be told either to calculate it using months or days. So do not be confused by this days in brackets, because that just means that you can use days instead of months. But as I said, if you have to calculate, let's say, food inventory, you do not use the general COGS account, but you use food COGS account. So always be careful. If you are not calculating the general ratio, then you always have to use the account that's connected to the ratio that you are calculating. The same one is for analysis, but that should be pretty easy. You just multiply it by 365 and divide by COGS, and that will give you your historical period of operating cycle for the particular thing. So next thing that's very important for this course is free cash flow. So free cash flow easily is what is left when everything is paid for. So so far we are familiar with cash balance on the balance sheet and the change in cash on the statement of cash flow, but this is another form of calculating cash ratio. It's the free cash flow. So free cash flow definition is it's generated by the firm and it's available to cover all cost of capital. So it's debt of equity minus sources of funds. So it's the money that's left for the owners. So that's why it's important to have a positive free cash flow. So you can calculate it using two ways, but usually the preferred way is to take EBIT, multiply it by 1 minus tax, and then plus depreciation minus change in working capital. So we spoke about change in working capital. That's just the sum of changes in all your current assets and current liabilities. You also have to minus the investments. Be very careful on the Excel. When you calculate investments, you have to take into consideration the depreciation. So when you calculate investments, usually it's the best to calculate the ending balance of last year plus the depreciation to see what would be the account balance this year without any investments. Right, and then you can also calculate if there were some investments or not, but never forget the depreciation account when calculating the investments. But you can also get it the other way around. You can calculate operating cash flow plus investing cash flow plus interest times 1 minus tax, and that will also work. And we'll have solvency analysis times interest earned. Indicates the ability by the firm to pay back the loan, so to pay back the interest mostly. It must absolutely be higher than 1, but if you want to get more loan, it should be around 3 or a bit more. So if this ratio is 5, what does it mean? If the ratio is, for instance, 5, that means that you can pay back 5 times more loan that you have at the moment. So if this ratio is lower than 1, that means that you cannot even pay back the loan that you have right now, and the company will probably go bankrupt because you will not be able to pay back the loan. Calculated by the summing net income, interest expense, and the tax expense of the year divided by the interest expense. Debt to equity ratio, as I said, this one is the very famous Hertz case. Total liability divided by shareholders' equity. It will indicate the proportion of total liabilities compared to shareholders' equity. So for instance, let's take 2 examples. If this ratio is 5 or if this ratio is 0.5, in case this ratio is 5, that means that the company has 5 times more liabilities than the equity, that's not a good sign. But if this ratio is lower than 1, so let's say 0.5, that means that you have twice more shareholders' equity than you have liabilities. That's much better sign. But for hospitality, let's say that to have this ratio 2, it's totally fine. Of course, for asset-heavy companies, you should have higher ratio. It indicates the proportion of the balance sheet that it's debt, it's finance versus the equity finance. So debt financed part of the balance sheet versus equity finance part. And then we have the last part, that are market invest ratios, earnings per share, EPS, you know it from last year, it's just net income divided by the average number of shares outstanding. Also, you have to subtract if there are preferred dividend. I don't know if you remember from the FA what preferred dividend means, but it's no need to know exactly what it means. You just have to remember, in case you have it on the exam that last year the company paid $500,000 of preferred dividends, you have to subtract this amount from the net income. It measures the return on investment for stakeholders. So these ratios are the most important for potential investors, right? Price to earning ratios. So this is famous for Tesla case, for instance. You will always need the current market share to calculate this one. You will divide the price of current market share, divide it by the earning per share. It measures the relationship between the current share price and the earning per share. Of course, the higher, the better. Tesla, I think, has a ratio of around 1,000, but we'll say between 15 and 40, it's good. It calculates how many years you will be needed to cover the price of investment, right? If this ratio is 20, that will mean that in 20 years, your investment will be covered. So you will have to own the share for 20 years to cover its cost. So no PE rate is good or bad. It's within the norm or not. So we cannot really say if it's good or bad, because if it's 2 can be good, if it's 200 can be good, but you just remember the industry norm, and so you're right. So the ratio is within industry norm, because if it's not, if it's too high, it can be suspicious. If it's too low, it can mean that the company does not have a good forecast for the future. Dividend yield ratio, so this one is as well very important for you as potential or actual investor, because it calculates how much will be your direct return. So dividends are your direct return. Your indirect return, as I said before, is the boost of the stock price. But this, to gain something from the indirect return, you will have to sell your stock, and sometimes you don't want to sell your stock, right? Because you want to keep the price of the stock keep rising. So the other possibility for the company to give you something back is in form of dividends. So the dividend yields, it compares, so dividend per share. Are the dividends declared divided by average number of shares. So always also be very careful. It's dividend declared, so it's not the dividend paid. Especially for the US companies, sometimes you have some dividends declared that had not been paid. So be very careful about that. If you have to calculate this ratio using just the data from the statements. And it's divided by the market price per share. So once again, for two ratios, you will need to use the current market price. So if you see on the exam current market price, you know that's important for the market or investor ratios, and not for the others. That's in general what it's important to remember. Okay, so we've actually, in exactly 1 hour and 15 minutes, we've come to this first part. Now it's time, if you have any questions from anything that's available on the LMS, from anything else, any general questions about the course. We'll wait a few minutes probably. You can post any screenshots in a chat, write in a chat, unmute yourself. Anything about the presentation? Was there something that was not clear enough? Would you like to see some practical example of something in the Excel, or is mostly everything clear? Okay, let's see. So we have some questions. So the current liabilities exclude for current portion of long-term debt, mortgage, etc. So in the financial accounting, they included they included the part that was due to be paid in less than a year. But what we tend to say in this course, as it's also on the slides on the LMS, because this presentation is just mostly was made using the slides on the LMS and just combining them. It's the accounts payable account in this course is reserved for your inventory. That's because you have to know the term of free money. So free money is actually the money that you get from your suppliers, and that's the money that you use without paying the interest. So that is why in this course it's not, the focus is not about how much it must be paid within 1 year, but it's about how can you use your accounts payable for the longest possible period, and that's the focus of this one. I hope that's clear. Yeah, but I know it can be a bit confusing because it's a bit different than it used to be, and in the financial accounting. But just remember, whenever you have accounts payables in this course, that's more about how is the company using the deferral period, and not really about the long term portion of long term debt or mortgage. Hope this was clear. Any other questions? Anything from the Excel sheet? Okay, shall we wait 2 more minutes if there's any question? Tax rate is 22. Let's see, could you please show development to get the profit margin for ROA? Okay. Okay. Had some technical issues. Okay, sorry about that. Yes, let me just see. I lost the question part. Okay, so could you please show the development for the profit margin? Okay, so you have here, you need to have your but this I think you're not showing me the right statement, because you need if you want to calculate the profit margin for return on asset, you need to take a look at the income statement, and that's where you will find your EBIT. Because you need EBIT for your but I can just write it, so it should be your EBIT amount that it's not really visible from this one, and then it would be divided by 1 minus 0.22. So you just multiply for what's the rest. Yeah, okay. Yeah, you just it would be like this one, and then you should divide it also by the net sales. Average, I don't get the average assets, right? Just let me just answer the other question before. Before calculating the operational cycle, we must first have the three ratios. That's absolutely correct. So you will always need to calculate these three ratios. So as I said already, be very careful if you have a general operational cycle, or you have a food, or let's say food beverage operational cycle, because if you have a general one, you use exactly the formula that's provided here. But if you have, for instance, the food operational cycle, you just use the accounts that are connected to food. So usually you don't have food account receivable. That's common sense. You have accounts receivable, but it's divided by the food revenue. And here you have food COGS. So that's how you use it. And then after this, you will calculate operating cycle or operational cycle by using this equation. And the other one was, I don't get the average assets, right? How do you mean? You mean how you get the average assets? Because so you get the average assets by summing the assets from this year plus the assets from last year divided by 2. So whenever you need to use the average of some account, then that's the formula that you need to use. For FAT, should we depreciate the fixed assets found in the income statement or take them directly from there? So I'm not sure what the FAT is supposed to mean. Can you just FAT fixed? Oh yeah. So for this one, yep. So depreciate the fixed assets. No. You will always have the net assets in this course. You don't have. I mean, you never have it depreciation on a balance sheet. You will have your depreciation expense of the previous year on your income statement, or of this year on your income statement, but you will not have accumulated depreciation on a balance sheet. The assets that are on your balance sheet in this course, they are always net assets. Sorry, I was just a bit confused about this, since it's divided by average net fixed asset. Yes, that's why it's net fixed assets. And also in this course, you will always have indicated the net fixed asset. So net fixed asset is acquisition cost minus accumulated depreciation. But as I said, so I can, however, show you. Okay, let me just show you briefly one example of what I meant with. Just let me find one. So one PowerPoint, one exercise. Let's take the showcase. So, okay, that's what I meant by investing, right? You have to check. So disregard this one. So you have to always check, right? So this is the year that we are looking at. So, and this is the year -1. So if we take a look at the buildings, for instance, how do you know what should the buildings account be like? So you will take the buildings from the last year and you will plus the depreciation of the buildings, where you find the depreciation on the income statement. So depreciation of buildings was 35. You have to minus it, of course. And you can see here that the value is exactly the same, the value it should be, right? So in this case, there was no investment because the value matches the predicted value that it should be using the depreciation. But if we look at for furniture and equipment, this one should be furniture and equipment minus depreciation of furniture and equipment. And this one should be what? This one should be equal to 2008, 208,000 but it's not, as you can see. So you can see that the investment in this case was the difference between these amounts. So 75,000 was the investment in last year. Why? So I hope this was clear also. Be very careful. I think it's in this one for the dividends. If you have the dividends, yes, it's in this one exactly. So you always check when you are calculating the financing cash flow, the dividends here in this case, and also on the exam possibly, the dividends will not be given to you. So you will have to calculate the dividends. How do you calculate the dividends? Once again, we'll disregard this one. You have to check the retained earnings account. So this was the last year, year minus one, and you will plus the net income, because the net income will go to your retained earnings. So you see in this case that these two amounts, they do not match, right? So you will calculate the dividends in this case using the predicted amount. So I call it the predicted amount. It's what it should be if there was no dividends minus the actual one, right? So this one minus the actual one, and you will get the amount of the dividends. So these are the two accounts that you have to be careful. Also, the third account is which one? So the long-term loan. Also, when you have to calculate the entire income, the cash flow statement, your reimbursements will usually not be given, right? And you have to calculate your reimbursement using financing cash flow. So that's why we use this amount to see what is the difference, right? So we just minused last year minus this year to see the difference. So we can see that because it's negative, that means that we paid this amount back. So our total balance of the mortgage is minus this amount. So this amount has to be taken in consideration here. Mortgage difference, that's the money that we paid, that's not given as well. So these are the three accounts that be careful of. So the depreciation ones, calculate the predicted value, the dividends, so retained earnings, calculate the predicted value, and also for the mortgage, if it's not given, it's very easy to calculate it. So that should be, this was like the practical explanation of how to calculate it. So I think there is not many people left, but I will still wait a few minutes if there are any other questions. So for free cash flow, when can you do investments? Was it 4 minutes ago? I missed this one, sorry. For free cash flow, when can you do investments? So you have to for the free cash flow, right? Let's see. So I don't know what's meant. So when you do investments, when you calculate the free cash flow, you have to minus your investments. So any purchases of fixed assets must be minused. Yes, please, Mark. I don't really get what you mean with this question, but.
Yeah, no, because in her PowerPoint presentation, the formula is minus investments, but I sometimes did plus investments and I got the same result. So I'm just a little bit confused. And she also sometimes did plus investments. So does it matter if you do minus or plus? Of course not, but I mean, when would you do minus and when would you do plus investments?
Well, I think that's just the case of if you spend money for investments or if you sold your fixed assets to get the money, because if you sold fixed assets to get the money, then your investments will theoretically, so you will have a positive balance, but because it's money received, so here it's meant. It's normally it's that you spend money for investments, right? So when you will spend money for investments, you will have to minus this amount here. But when you receive the money from investments, this will be minus already, so it will be the plus at the end. It's just the matter of the sign, if it's plus or minus. But usually you will have investments that will be minus. So I can show one example again. And it's just a matter of the sign, right? So here, for instance, you can see that you used $75,000, I think, for investment in furniture and equipment. So when you have a free cash flow here, you will have still a minus for investments, but it's just on the equation here. I know it says minus investments, right? But that's just because investment in your case was not minus 75,000, right? Your investment was 75,000 because you invested 75,000, and that's why there is a minus in the equation. But if you sold the piece of land for, let's say, so this amount would be positive, right? If you had a positive amount here, that's the opposite of what I just said. So here at the end of the day would be a positive sign, but normally it should be negative one. But as I said, just look at your if you have investing cash flow, that's the best. Otherwise, you just calculate the investment here, right? So we got the investment here of 75,000, right? So in this case, you would minus this investment. I hope this explains the question.
Yes, thank you very much. Thank you very much. Thank you.
I think there is nothing else that the teacher really highlighted to be shown in the Excel. I think it will be mostly clear. But any tips that she said, I think she just mentioned to me during our session for the recap that just try to do the Excel as quick as possible, but don't make silly mistakes in the Excel. So it's a general tip that's very not very useful usually, right? Because if you are very quick in the Excel, then you can make silly mistakes. So just try to double check it, right? That's what she said as well. You have two ways of calculating it here. Maybe for the free cash flow, if you have to calculate it using the other one, it's even easier. But just if you have investing cash flow, don't calculate the operating and investing cash flow if you don't need to calculate it. But in the event it's given, you can also use the other formula for the free cash flow, and that's going to work perfectly as well. Yes, please.
Hi, so I just had a question. In case we get one of like the Joe cases, do you think it would be more like part C or like from the first parts that we did?
Yeah, for the exam, I think since it's just 1 hour, also I think Sally's cupcakes, she also mentioned that's really the best one to do to see if you can do forecasting. But of course, on the exam, there's not going to be such a long case because it takes you 45 minutes and then you can do nothing else. So on what to expect on the exam is probably very similar to the two past exams. So maybe 5 or 6 ratios that will need to be calculated, and then one exercise some blank fields that needs to be found out using the different statements. There could be some general calculations to do, and then there is an open question: which company you would invest in. But also be careful if you are doing the previous exams on the LMS. There are always, I think, 2 open question exercises, but since it's on the LMS, she said that there will be just 1 open question exercise, not 2. So it will be a bit shorter, yeah.
Okay, thank you very much.
You're welcome. Yeah, otherwise just use the advantage of the Excel. Excel is great. It can go really fast if you know how to use it, but just be careful as well. Yeah, to not make silly mistakes with the calculation, and that should be perfectly fine then. Okay, well, let's wait 1 more minute if there's still any question, and if not, we'll close this session. Yes, thank you. Perfect. So then let me just wish you good luck on the exam. Just let me maybe invite you also tomorrow, same time, 7:30. There will be a recap session for the course statistics. It will be a bit longer than today, I think. I will be presenting again, and for today, I think we can conclude this one. Yes, thank you also very much for attending this session, and let me wish you a very pleasant evening and good luck on the TIFA exam. And do not forget that this session is always available for you on YouTube, and PowerPoint is available for you on the EHLRecap website. Thank you and have a great evening.
Thank you much, Mike. It was great. Thanks.